Welcome to Facts Not Forecast, your daily edge in the stock market, facts, insights, and opportunities you won't hear anywhere else. Today, we're taking a deep dive into Palo Alto Networks, a real cybersecurity powerhouse. And our mission today is basically to unpack their recent financial performance, their strategic shifts, and, what all this truly means for their position in this, rapidly evolving tech landscape. Are they building an unshakable fortress against the next wave of cyber threats, or maybe just riding the AI hype train? We're going to find out.
Yeah, it's a fascinating deep dive. We're looking at a company that's been making some incredibly significant moves, not just, in their financial results, but fundamentally altering their strategic direction, particularly around that crucial and ever-expanding realm of artificial intelligence and cybersecurity. The stakes couldn't be higher, really,
Yeah.
for them and for their customers, too.
All right, let's dive straight into the numbers then. Let's start maybe with a quick look back, specifically at their Q2 2025 results. What was the headline story from that quarter?
Okay, so for the second fiscal quarter of 2025, Palo Alto Networks reported a diluted non-GAAP earnings per share, EPS, of $0.81. Now, this was a notable beat. It actually exceeded the analyst estimate, which is $0.78.
81 cents versus 78, okay.
Yeah. And when we talk about non-GAAP, it's important to remember this gives us a clearer picture sort of their core operational profitability. It excludes certain, one-off or non-cash items like stock-based comp or amortization stuff. So outperforming here, that's a strong signal. So there's efficient core operations.
That's a solid beat, definitely. Now, let's shift gears a bit and zoom out. Let's look at their latest reported fiscal year end, which is Q4 2025, and the full fiscal year. What were the standout numbers there, the ones that truly jumped out at you for the full period, and what kind of picture did they paint of the company's health?
Right. Well, their Q4 fiscal year 2025 results, and really the full year, show pretty robust performance across the board. Total revenue for Q4, it hit $2.54 billion. That's marking a 16% year-over-year increase. And crucially, it surpassed their own guided range.
16% year over year and ahead of guide. Nice.
Exactly. And this growth was largely fueled by product revenue, which itself grew 19%. And here's a key point. Software form factors contributed 56% of that product revenue. Services revenue also saw healthy growth, about 15%.
Okay, software becoming a bigger piece of the product pie. And what about profitability? That's always critical, right? Especially in a market like cybersecurity. How did the margins stack up?
Absolutely. Profitability is key. Their total gross margin was very healthy at 75.8%. But here's where it gets really impactful, I think. For the first time in the company's history, their operating margins actually expanded to over 30% in Q4.
Over 30%? Wow.
Yeah. And the full annual operating margin reached 28.8%. Again, above their guided range. This isn't just about, cutting costs. It signals a maturing business model. Their scale lets them leverage existing infrastructure more effectively. It's a powerful indicator of increasing efficiency and their ability to turn revenue into real profit. Something a lot of tech companies, especially in high growth phases, kind of struggle with.
Right, that leverage is important.
Yeah.
So connecting these dots, how did all this translate into the bottom line, the ultimate profitability and earnings?
So their diluted non-GAAP EPS for Q4 came in at $0.95, also comfortably ahead of expectations. But beyond the immediate earnings, what's incredibly compelling is their future revenue visibility, their remaining performance obligation, or RPO. It grew a significant 24% to $15.8 billion.
$15.8 billion in RPO. That's huge.
It really is. RPO is essentially their backlog, right?
Yeah.
Future contracted revenue. So this growing number signals strong, long-term customer commitments, impressive visibility for quarters, maybe even years ahead. We also saw their next-generation security, NGS, annual recurring revenue, ARR, that grew a robust 32% to $5.58 billion. And net new NGS ARR added another $490 million. These figures just scream strong, predictable future revenue streams.
Okay, strong visibility, strong recurring revenue growth. What about cash generation? How did free cash flow look, and what does that tell us about their financial flexibility?
Yeah, cash flow was remarkable. They delivered a 38% free cash flow margin. And that's for the third consecutive fiscal year.
Third year at 38%.
Right. It means they're generating a ton of actual cash from operations. That gives them immense flexibility for, strategic investments, M&A, maybe even returning value to shareholders. Plus, their bookings growth was the highest seen in 2.5 years. That was largely propelled by a record number of these platformization deals they talk about.
Platformization again. We'll get into that.
Exactly. It indicates really strong demand for their integrated solutions. And they also reported impressive growth in large deals. Customers spending over $5 million, $10 million in ARR. That was up roughly 50% year over year, and customers with over $20 million in ARR were up nearly 80%. So it's not just new customers, it's deeper, expanding relationships with their most valuable clients.
It's truly fascinating how these strong numbers seem to connect directly to their strategic decisions. So, with that kind of financial momentum, the natural question is, how are they doing it? What are the strategic levers Palo Alto Networks is pulling? And specifically, what is this platformization strategy all about?
Well, at its core, it's exactly that. Their platformization strategy. Think of it like this. Instead of buying a separate lock, an alarm, a camera system from different brands for your house, Palo Alto's platformization is like offering one integrated smart home security system. They're shifting customers away from managing, multiple fragmented security products, which often don't even talk to each other properly now, towards a unified integrated platform.
Makes sense. Simplify things.
It's exactly. The company argues, pretty convincingly, I think, that this delivers superior security outcomes. It simplifies the whole security stack for IT teams and ultimately optimizes costs for customers, leads to faster incident response times, better user experience, less complexity. And the proof really is in the pudding, as they say. Their net retention rate among platform customers was an impressive 120%.
120% net retention.
Yeah, with nearly zero churn.
Yeah.
That isn't just a number. It's a testament to how sticky and, frankly, indispensable their integrated platform becomes. Once an enterprise commits, the cost and complexity of ripping it out and switching, it becomes incredibly high.
Yeah.
That essentially locks in long-term revenue and insulates them from competitors.
So platformization isn't just bundling, it's really about a more effective, holistic security posture. And you mentioned AI earlier as a key driver. How does artificial intelligence, which is, let's face it, a massive buzzword right now, how does it play into this integrated picture? Not just marketing fluff, but as a true accelerant.
AI is absolutely an accelerant, but for Palo Alto Networks, it seems like much more than just a buzzword. They're positioning security as like a foundational enabler for the massive AI transformation happening everywhere. They recently completed the acquisition of Protect AI this quarter, enhancing their capabilities there. And they introduced their own Prisma AI security platform, plus a suite of AI access solutions. And look at the numbers, they're staggering. Gen AI traffic was up over 890% in 2024.
890%.
Yeah. And security incidents related to Gen AI more than doubled since last year. This rapid AI adoption is creating this complex new attack surface that traditional security solutions, frankly, just aren't equipped to handle. It makes integrated AI-native security not just nice to have, but absolutely essential.
Speaking of new attack surfaces, I saw a fascinating point in the material about the browser becoming critical in enterprise security, almost like a new battleground. Reminds me a bit of the old browser wars, but with a modern, maybe more serious twist?
Exactly. It raises a really important question for modern businesses. As the browser evolves into what's essentially the new operating system for many enterprises, the primary interface for AI tools, SaaS apps, cloud data, securing it is just no longer optional. We're seeing consumer browser wars where AI agents get integrated directly, right? Well, the enterprise version means a much more sophisticated critical threat landscape. Palo Alto Networks clearly believes this evolution necessitates secure enterprise browsers. Their Prisma Access browser, for instance, saw over 3 million licenses sold in Q4 alone.
3 million in one quarter.
Yep, doubling their cumulative seat count to over 6 million. This is becoming a critical part of their SASE stack. SASE, for listeners, Secure Access Service Edge. It basically combines networking and security into a single cloud-delivered service. Ideal for securing today's distributed workforces and cloud apps accessed, mostly via the browser.
That makes perfect sense. So while they're expanding into new areas like AI, secure browsers, what about the core, their network security business? Are we seeing a significant shift towards software within that foundational segment too?
Absolutely. Network security still accounts for over 75% of their bookings. That shows its enduring importance. But the really exciting shift is that over 60% of those bookings are now driven by software form factors. We're talking solutions like SASE, which we just mentioned, and virtual firewalls, basically delivering firewall power in flexible software.
Okay.
Their software firewall business specifically saw AR up nearly 20% year over year, and they boast nearly 50% market share there. This shift offers huge benefits for customers. Faster deployment, instantaneous scaling, much more efficient upgrades compared to traditional hardware, which can be, cumbersome and costly to manage. It's a clear move towards agility and cloud-native operations.
Okay, shifting gears a bit now. Beyond the current performance, there's been some notable news about leadership and also a proposed major acquisition. What's the latest there, and how do these moves kind of shape their long-term vision?
Yeah, two significant pieces of news. First, Nir Zuk, the company's founder and highly influential chief technology officer, he decided to retire after more than 20 years, which is a big deal,
It's
obviously.
definitely an end of an era.
It is. But this isn't a jarring departure, it seems.
Mhm.
Lee Claridge, who was EVP and Chief Product Officer, he's now been appointed Chief Products and Technology Officer, and he'll also join the board of directors. So it marks a significant, yet seemingly seamless transition in their tech vision, ensures continuity.
Okay, continuity there. And then there's the proposed acquisition of CyberArk. That feels like quite a bold move. Why this acquisition? Why CyberArk? And why now? How does it fit the broader strategy, especially with this AI focus?
This is a truly strategic move, I think, into the identity security market.
Mm-hmm.
Palo Alto Networks believes, and the logic seems sound, that the widespread deployment of AI agents, these automated things acting for users, makes privileged access management more critical than ever.
Right, if an AI gets compromised.
Exactly. If an AI agent has compromised credentials, it can wreak havoc across an enterprise way faster than a human could. And the statistic is pretty stark. 90% of breaches involve stolen or mismanaged credentials. So they see identity as the key enforcement point for enterprise security going forward. CyberArk is a leader in this space. They bring over 8 million privileged end users, cover over half the Fortune 500. The synergy they're banking on is clear. Palo Alto leverages its massive go-to-market reach to expand CyberArk's presence into their much larger 75,000 customer base. This isn't just adding a product, it's about completing a critical piece of the security puzzle. And they're targeting a 40% plus adjusted free cash flow for the combined company by fiscal year 2028. That's a very aggressive, confident target.
40% plus adjusted free cash flow combined. That is ambitious. A powerful vision for the future, then. So bringing it all together, strong performance, these strategic shifts, the acquisitions, what does it mean for their outlook, their guidance for fiscal year 2026? Or are they still as bullish on their trajectory?
Oh, they absolutely are. For fiscal 26, they're guiding for that NGS ARR next-gen security recurring revenue in the range of $7 to $7.1 billion. That represents 26% to 27% growth. Still very robust.
26 to 27% growth on NGS ARR.
Yep. Total revenue projected between $10.475 billion and $10.525 billion. That's an increase of 14%. Diluted non-GAAP EPS expected between $3.75 and $3.85. And they anticipate continuing those strong adjusted free cash flow margins, 38% to 39%, consistently delivering substantial cash. And a key metric they highlight is expecting to stay above the rule of 50 for fiscal 26.
Ah, the rule of 50. Remind us quickly.
Sure. It's a quick health check for SaaS companies, essentially. Revenue growth rate plus adjusted EBITDA margin should add up to over 50. Consistently exceeding this, like they have for the past 5 years, is a strong indicator. Shows both high growth and solid profitability. A good balance.
Okay, so the company's guidance reflects continued confidence. This all paints a very positive picture. Financial strength, strategic foresight, strong future guidance. But what's the broader market sentiment on Palo Alto Networks? Are there any nuances, maybe conflicting signals we should be aware of? Are analysts universally convinced, or is there maybe some divergence of opinion?
Generally, analysts maintain an overweight recommendation on the stock. The average target price is around $213.21. Though there's a range, obviously. High of $240, low of $130. We've seen reset upgrades, too, from firms like Deutsche Bank and Piper Sandler back in August 2025. So that aligns pretty well with the strong results and the strategic moves we've discussed. Broadly, Wall Street seems to like the story.
That seems consistent with everything you've walked us through, but I did notice some recent insider selling activity mentioned. Is this a red flag for investors? Or just, business as usual? How should we interpret that?
That's a fair question. It's true, several executives, including Nir Zuk, before his retirement, Lee Claridge, other officers, they've had some insider selling activity recently. Now, while it's always worth noting insider transactions, it's also pretty common for executives to sell shares. Often it's part of pre-planned compensation plans, or just for personal diversification, especially after exercising options, or maybe after a strong run in the stock price. So, by itself, it doesn't inherently signal a negative outlook on the company's future. It's just one piece of the broader puzzle investors need to consider.
Right, context matters there. And finally, what about the more short-term technical indicators? Sometimes they offer a different perspective than the fundamentals, don't they? Do they echo the positive fundamentals or maybe suggest a bit more caution for traders?
Yeah, this raises that classic question about balancing different forms of analysis, right?
Right.
Fundamentals versus technicals. When you look at the technical analysis here, it actually shows some mixed signals. While certain short-term oscillators might indicate a buy trend, many key moving averages actually suggest a strong sell signal.
Oh, interesting. A disconnect there.
Exactly. It highlights that while the fundamentals and the long-term outlook might look robust, as we've discussed,
Yeah.
short-term trading signals can be much more volatile or even contradictory. They often reflect current market dynamics, maybe specific short-term technical patterns, or even just algorithmic trading activity, rather than the underlying business strength itself. It's a good reminder that fundamentals tell one story and short-term market movements can sometimes tell another entirely.
So, our ultimate takeaway from this deep dive into Palo Alto Networks, they seem clearly in a strong position, leveraging platformization, AI, making bold moves like CyberArk. But those mixed signals on the technicals, the, expected insider selling, they remind us that vigilance is always key. It leaves us pondering, doesn't it? How will their ambitious moves in AI and identity security truly reshape the competitive landscape in the years ahead? And can they really hit that aggressive 40% free cash flow target with CyberArk integrated? Definitely something to think about as you navigate the market. Appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.